focus today will be on the effect that integrating ESG risks will have on our RBC framework, especially within Kenya as a country. Anyone who is involved in the insurance industry directly or indirectly is very aware that we are heavily affected by our RBC calculations and position as insurance companies, as those who consult for them, as auditors. It is a very key part of an insurance company's metrics. So even dictating the opportunities that are available to our company, dictating how they're able to perform their operations, it forms a very key role in the insurance industry as a whole. And so with that in mind, it is very important to keep track of all the factors that would influence or impact the computation of this RBC and consequent CAR. So for example, everyone is probably aware that IFRS 17 is becoming a key part of our market now. And so we know that it'll have some effect on RBC, and we can already see the impact that is having on the concern that we, as industry players, as board of directors, as any person with a stake in the insurance industry, we can already see the concern that has, seeing whether that will impact our RBC, whether positively or negatively. So another key thing that will probably start to affect our RBC in the coming future is ESG. And rather than playing a game of catch up, we are happy to and very lucky to have this ESG Africa task force that is going to enable us to get ahead of the game and start to figure out what sort of impact ESG risks would have on our RBC framework. And so today we are joined by Elias Omondi, who is an expert in the field of ESG and ESG risks. And he will take us through he'll take us through a brief introduction of what ESG is and how it would possibly affect us as a market, the financial market as a whole, and also specifically the insurance industry, and then focus on the RBC framework and how it is currently being computed and how ESG risk could probably be integrated into that framework in order to more accurately reflect a company's solvency and risk position. So without further ado, I would like to welcome Elias to begin his presentation.
It's good to be here today, and generally, Sanau has kind of just provided a brief on what we'll be discussing today, and maybe just to give a brief of what I'll be talking about. I'll be talking about sustainability risks and how that is kind of connected to what we are currently used to. So in this case, then, if you're operating within any specific market within this continent of Africa, there are those particular countries that have gone ahead and introduced what we call risk-based capital. And also they are currently guided through the risk-based supervision statutes. And that basically enables those particular countries to ensure that the risk that any company undertakes is commensurate to the risks, to the capital that they are holding. So I want just to discuss this particular topic and maybe just to bring into context on what we would basically expect to change. Further, I'll also discuss a tool that I've been developing over the last couple of months that kind of now integrates sustainability risks, particularly on risk-based capital framework. So if you allow me, I'll be sharing my screen with the slides just to make sure that we are able to view. So hopefully you can see my slides.
Yes, we can see your slides.
Just I want to put them on the presentation mode, right? So thanks. So I just want to discuss this particular topic, but maybe before I discuss this particular topic, I want to start from what sustainability means to us, particularly within the financial sector, and then connect that to the requirements that we are currently conversant of RBC and see what will be able to change. Over that, then I'll be able to share a tool with with some of the results that I've managed to conduct within a particular market. Not within the continent, but this particular market is in Asia. So those results that you'll be able to see is from a country in Asia. Right. So Elias Omondi, Senior Manager, Risk Regulations at FSD Africa. My role at FSD Africa is to ensure that we support creating of an enabling environment within risk market. So I work predominantly with the insurance regulators and also policymakers across the continent to ensure that in terms of the regulations and toolkits that they develop enables the financial sector markets to grow. In terms of FSD Africa, we make finance work for Africa's future. So we work we are a company basically supported by the UK government, by the basically the UK aid, and our work is to make the financial markets in Africa to work. So we work to develop financial sector within the continent. We work across the continent. So far, we've worked with over 30 countries in Africa, managed to develop a number of policies, but also have really supported market development within the continent. So you can basically check out on our website at fsdafrica.org. Yeah, so maybe just to then dive into the discussion, and particularly if you come from an insurance background, you will be able to see how the insurance sector supports sustainable development. And if you look at that, then there are three critical components that come in mind in terms of the insurance role, whereby they support financial risk management. We have risk managers role, whereby we look at how then we support physical risk management, but also there's a lot of investment that come through the insurer's balance sheet. So in that particular case, then the investor role comes in, whereby you'll be able to see there's a lot of asset management. And these three critical components then presents a very good ground for sustainable development in terms of both challenges and opportunities. And we are going to look into this particular context. And just with that, then you can see that the insurance sector holds a lot of what we call assets under management, around 30 trillion, over 30 trillion USD across the world, but also looking at around 5 trillion word premium volume. So a lot of resources that really presents us an opportunity both to support sustainable development, but also these particular resources are also exposed to challenges that might need solving. Now, if you look at the way the role of business has evolved, and this will kind of provide the background of what we will intend to do as with what we are going to discuss today. So if you look at where we've been coming, we came from. So in the 1800s, you could see that most of the companies were using their resources to create profits, and these particular profits would be accumulated in assets for purposes of the shareholder benefit. And that has kind of evolved, whereby in the 1960s, then corporate strategic philanthropy started coming in. And in this case, then we saw companies coming up with some brands that would support in terms of providing charitable donations and in terms of really volunteering. Then that evolution has kind of even further grown, whereby we've seen corporate social responsibility, CSR programs coming into around 1980s, whereby now companies or businesses acknowledged that they needed to respond to some of the societal challenges. And in this case, then that in one or the other was outside their core business. So they were just setting a CSR unit that was not really connected to the core business processes. But what we are currently looking into is that we've seen organizations nowadays trying to be part of the solutions that really affect a couple of societies. So if you look at this, you'll see that now societal challenges are now becoming an opportunity to the business units. And in this case, then the organizations are looking at it as a key obligation that as they work within their business strategies, then these challenges come into the center of the process. Now, these some of the examples of some of the companies that have kind of seen that evolution. So you will be able to see that if you kind of look at BP, currently they talk about efficient energy. If you look at IBM, we talk about smarter cities from what we used to talk about previously on computing. Discovery Health is now looking into from insurance to health and wellness. So kind of a big evolution whereby companies are already redefining their corporate purpose. And if you look keenly on this components that they're bringing in, you'll be able to realize that they are looking into addressing some of the societal challenges that we are currently experiencing within the world, in the world. So then, what then comes in mind is then what do we really mean by ESG, environment, social, and governance, and this basically a set of standards that basically brings together a framework for understanding the impact and the risks that an organization really is exposed to beyond its financial performance. And if you look at that, then these three letters critically presents to us both risks and opportunities within our continent. So for instance, if you look at the environmental issues, there are issues around climate change, and all of you are aware that this year COP27 will be happening in Africa. So that basically gives us an opportunity as a continent to address some of the challenges that we are currently facing, particularly on issues on climate change. But also above that, then there are issues around carbon emissions, issues around pollution, issues around biodiversity, in terms of how then do we respond to nature risks. And in that context, then you'll see that most of the African continent, particularly the resources that drive our GDP, are highly connected to both climate and also nature. It is estimated that 65% of most of our resources within the continent are highly driven by nature. That means that if we don't really take care of biodiversity, and if the financial system or the financial sector does not keenly look into issues around nature, then in this case, then we might really lose the critical component of supporting the continent that we are living in. Then over and above that, we are kind of seeing an evolution on societal issues. So particularly customer satisfaction, and if you are within the insurance sector, you'll be able to understand what customer satisfaction is all about. Issues around trust is something that is keenly being discussed within this particular sector. Issues around data protection and privacy. We've seen different countries already coming up with data protection laws, and people are so keen on issues around privacy, gender, and biodiversity. So these are some of the key issues that has an impact and will have an impact on an organization beyond its financial performance. Governance is also a key thing that also need to be looked at, from the issues around board composition to issues of bribery and corruption. These are quite key components that really bring together what we term as ESG. So why is this then an important component? So if you look at ESG, you'll be able to see that ESG provides a very measurable framework. In this particular case, then it will give us an opportunity whereby measurements will be done globally and will help us track some of the key sustainability issues. So in terms of the E, S, and G. So it is quite important aspects that organizations need to align their business process around these three critical components of sustainability. But also within that, then we look at ESG providing a risk analysis and resilience toolkit. In this case, then it will give a holistic risk management assessment that will ensure long-term resilience within various businesses and also as a very strategic outlook that organizations will be looking at. So on top of that, then we look at long-term sustainability in terms of how then this really impacts businesses, practices in terms of how the organization will be faring in the long run, but also driving the investment. So in this case, then you'll be able to see that investments will be aligned in a particular criterion to support long-term sustainability. So in this case, then the way investments will be done and what investors will be looking at in the future will also be quite different from what we are currently experiencing. So the insurance industry then comes at a stage whereby there is need for the industry to start thinking keenly on how sustainability will impact their business processes. So in this case, then you'll see that the industry over the last centuries has been critical in terms of risk management. They have been keen into enabling transfer of risks, particularly that have been impacting societies through adoption of some tools. So the key thing is that there is need to look at how those particular tools and investment practices will ensure also long-term sustainability of these particular societies. So some of the key components that we might need to mention, and this might mean that the industry might need to start considering ESG, is that key stakeholders will look at ESG accountability in this particular case, and investors and also different partners will be demanding greater accountability, particularly on ESG adoption. Further than that, we look into creation of sustainable insurance products, and it is something that will in one or the other change the risk landscape of various insurance companies across the globe. Over that, we've seen regulators coming in and looking into how then there's need to integrate climate-related issues within principles such as own risk and solvency assessment, and we'll be looking at how that could be done within this particular presentation. But also looking at issues around disclosure and whereby different organizations are now advocating for future sustainability, including UNEP that has developed principles for sustainable insurance. So quite a long front of what will be happening, what has already started to happen. And this basically means that this is a discussion that must be brought towards within the financial sector. Now, in terms of then how then do we really look into around the case for RBC? So if you are conversant with where we come from as a continent and maybe looking keenly within the Kenyan landscape, you'll see that the risk-based capital framework was developed to address a number of issues. So for instance, the previous system did not adequately assure solvency and protection of consumers. And in this case, then, if you could remember that the framework was more on a one-fits-all, regardless of the size of the company, regardless of the risks and the products that the company was underwriting. The amount of capital was not commensurate to that. Further, there was need to have a proactive look into the future, but also in terms of the financial health of the companies. So in this case, then there was need to have an assessment that will assure solvency beyond a particular point in time. So in terms of the long-term well-being of an institution was quite important. Further than that, then those need to incorporate risk management into business practices, whereby organizations that had a robust risk management infrastructure would reduce their level of the amount of capital that they might need to hold within the institution. Then that basically brought a number of implications. So, for instance, those need to link regulatory capital to the risk profile of the companies, and that brought in what we currently term as risk-based capital within the sector. Further than that, there was need to look at the risk profiling in terms of what are the predominant risks within the financial institution, how are they looking into managing those particular risks, issues around common culture in terms of ERM components within the organizations, but also just to ensure that there was a particular level of market disclosure and self-regulation. So a couple of key components and implications that really brought the need of looking at how the risks would be connected to the amount of capital that an organization was supposed to hold. Now, if you kind of broadly think about that, you realize that there's a very clear connection on what we are discussing now, particularly on sustainability, that will have clear impacts on risk-based capital framework. Maybe just to even further dive into this, if you are aware and you are conversant with what we currently term as Solvency II, and maybe if you look at risk-based capital framework, you basically term this as a simplified Solvency II framework. And risk-based capital kind of advocates and follows into that particular aspect. So you'll be able to see that there are three critical pillars that needs to be discussed, and how these particular components will be reflective on the sustainability risk. So for instance, we have capital requirements, and if we talk about capital, capital really depends on the interrelationship between assets and liabilities, but also what we term as shareholder funds, in which case then you'll be able to see that Pillar 1 also looks at own funds and also looking into issues around technical provision. So if you have an idea of what these will impact, Pillar 1 will heavily be impacted by sustainability risk, given that it is wholly dependent on the total balance sheet. So in this case, then it's predominantly termed that as a total balance sheet approach when it comes to risk-based capital framework. Then under Pillar 2, this is more on issues around self-assessments and governance, but also looking at how controls have been set in place. Now, critically, if you look at these self-assessments, supervisory review, risk management, you'll be able to realize that sustainability risks will also have an impact on this particular regard. So for instance, when organizations will be doing their own risk and solvency assessment, particularly components regarding stress testing, climate-related risk will be one of the critical components that will be they'll need to conduct some stress testing. But even as that is being done, governance will predominantly have an impact on the OSA process, particularly on governance regarding sustainability risks, the internal controls, how those measures are developed, and further in terms of really realigning the risk management prospects within this sustainability risks. Now, under Pillar 3, it's all about disclosure. And if you recall, one of the key components that ESG will be looking at will be disclosure. So that means that there's a critical balancing around disclosure and transparency requirements, particularly when it comes to the Pillar 3 components of the risk-based capital framework. That will mean that organizations in one or the other will be impacted in terms of the disclosure requirements that sustainability risks, particularly ESG, will bring into the fore. So just to maybe summarize this, this kind of depicts a capital appropriate support component whereby the businesses will be required to consider their size and risk profile by looking into these three pillars and establishing a capital requirement level for adequate capitalization or ensuring that companies have a proper buffer towards support of their obligations, but also just to ensure that, yeah, the risks are properly recognized and the organization has a clear way of addressing levels of maybe if a company will be a particular level of capital adequacy, then they must have an intervention component around the level of capital that they'll be holding. So maybe just to kind of dive into the risks that will be there and the type of risks that currently assessed within risk-based capital, you'll be able to see that there are issues around insurance risks, which basically means that the risk profile of the insurance business as it's written might change. And in that particular case, then the organization might require some amount of capital to take care of that. Then the issues around market risk, whereby the valuation, market factors, the prices of the assets might change. And that basically means that in terms of the company losing in terms of the ability for creditors to pay to pay the insurer, but also just look at the operational aspects in terms of the people, the processes and systems might have an impact on both solvency and profitability. So these are critical risks that we currently look at within the risk-based capital framework, but there's a very strong connection on how these risks will be impacted when it comes to the issues of sustainability. Now, over that, then there are different approaches, and I wouldn't want to dwell much on this, particularly on how this particular, how these key risks are looked into. So, for instance, insurance risk can be divided into a number of risks. Mortality risks, you can have issues around morbidity, expense, issues around premium and claims. We have market risks, whereby you can think about interest rate risk, equity, property, currency, and concentration, but also around operation and credit. Now, in terms of the approaches, we have two broad-based approaches, whereby some of these risks can be assessed through a stress-based approach, which in terms of the complexity is a bit more complex, because it means that you have to look at two scenarios whereby you have a pre-stress and a post-stress, and the difference between the pre-stress and the post-stress will give you the amount of capital that is near. But also there are some components that are quite straightforward, whereby you'll just have a factor applied to compute the amount of capital. Now, with all that, then we need to look at how maybe I've taken one component within ESG and kind of try to reflect on how these will impact the financial sector. And within that, then we will be able to connect what we've kind of discussed on the framework within the context of this particular discussion. So, for instance, if you look at climate change, it will have quite a far-reaching structural change in the economy and also the financial system. And that basically will fall within the mandates of the supervisors. This is according to the Network for Greening of the Financial System. Now, if you look at climate risks, there are three critical risks that come with that. So there's what we call the physical risks, transition risks, and the liability risks. And these will have an impact on both the economy and the financial system. So for instance, physical risks will have will kind of bring business interruption risks, which in the long run might bring within the financial system the underwriting losses. And if you look at how that is kind of transmitted within the channels of the economy and the financial system, these will highly be dependent on properties values. In case maybe an insurer has invested in property and there's a flooding, that means that those particular properties might not really have that high demand. And in that case, then they might lose their values, and they lose their value. That means that the balance sheet is impacted one or the other, and that has a clear impact on the capital of the institution. Then further than that, then think about transitional risks in terms of climate policy and the way the customers' preferences might change. That will have an impact on the products and the underwriting processes. And also just looking at how then these will look into issues around reinvestments and investments within the institution. So maybe a corporate might have a lower profitability because of a downgrade based on the policies that have been set up by the government and so forth. And that might mean that the financial market losses might be realized. So if just look at this, then you see there's a stronger interrelationship within sustainability and what the current financial sector is experiencing. And that's why it will be important for the financial sector to keenly look at how they support these key processes. So maybe just to dive into the risks that we had looked earlier and kind of now connect that to what we are observing within the sustainability risks. And I just want to kind of start with the physical risk. And these are risks that arise out of the climate change, and there are a number of factors that you can think about. So they can be weather events, they can be longer term shifts in climate, but also they can be part of the crystallization of some of the issues that will be impacted through weather. So for instance, the increased frequency of weather events might impact things such as property and also might impact casualty insurance. And in this then what comes in mind is that when it comes to market risk, the equity values particularly might lose their value because of those issues around flooding and business interruptions. And that in one or the other might impact the profitability. And if you think about profitability keenly, this is what at the end of the day comes within the capital resources component under the RBC. So you'll get that most regulators have already attached a capital charge on market risk. And in that particular case, then they only look at it from the short-term value of those particular property prices, just in case then there are these kinds of disruption that might have a very big far-reaching effect. Then that might even mean that there is need to look at how you take care of sustainability risks within the RBC component. In terms of the insurance risk, again, you get higher than expected insurance claims. And that means that there's need to really look at how that particular exposure will be taken into consideration when it comes to the available capital. So if claims become higher than expected, will the business be able to still stand, or the capital will be wiped out? Does it mean that there is need to think about capital when it comes to sustainability risks? Now, over and above that, there's issues around credit, whereby the institution might be downgraded based on their different exposures. So maybe some other institutions might be downgraded because they are not well, they're not really taking care of sustainability issues in a particular way. But on top of that, then there is operational risk, which basically means that the offices will be damaged. One or the other critical functions might be impacted. So, for instance, if there is no underwriting, there's no claims, that will have a reputational risk to the organization, and also looking at issues around liquidity that might lead to issues of higher cancellations. So yeah, so this is how then you'll be able to see that the physical risk that is within the sustainability risks will have a very clear interrelationship within the risk that we are currently talking about when it comes to RBC. Now, on top of that, then think about transitional risks, and this basically comes out from the processes of adjusting towards a low carbon economy. And this adjustment will include issues around policy and regulation, emergence of disruptive technology, but also just sentimental review, whereby the society will prefer different ways in which the products, some of the products that will be going to them. So maybe we'll see organizations are requiring more green products. And that case, then insurance risk will be impacted in terms of potentially underpricing. And if you look at underpricing, then that this will have an impact on the premium reserves. And within that, then there's a critical component that when you are determining capital, the required capital within the business process, then you need to look at how these risks will impact the capital process. So yeah, we know that there will be no adequate data for green technologies that will come out of this emergent disruptive technology, and that in one or the other will be transmitted to the insurance risk. Issues around market risk, whereby investment losses will occur, particularly when it comes to assets that will kind of be downgraded, or in this case, they might be stranded because of they are not basically best in class or something like that. So in that case, then market risk will be high. So when that happens, does it mean that if there was a capital charge of, say, 20% as per the RBC, and what will be the capital charge for stranded assets in some circumstances where these occur? That means that the capital charge for RBC might be, say, 100%. So that basically gives an indication of how then that connection is. But over and above that, there are other risks that we need to think about. Issues around credit risk, which is basically losses from corporate investments due to forced transition. So they might have transition happening, whereby organizations are required to transition, and you only transition when you've kind of taken care of some of these legislations that have been implied by the policymakers. On top of that, then the increased exposure to cyber when it comes to operational risk, but also just to ensure that liquidity risk might also come up, whereby political and societal pressures to invest on maybe green infrastructure investments might lead to some of the illiquidities, because some of these investments might be long-term. And again, if you look at the market, they haven't really gotten to that particular space whereby you can easily determine prices, and these particular assets would easily be liquidified as easily as possible. So then we talk about liability, and liability will arise from people and businesses seeking compensation. And in this case, then these will be connected highly with the physical and transitional assets, transitional risks. And you'll see that liability risks will arise, whereby there's need to take care of some of these particular losses. So in this case, then you'll be able to see that the direct impact will be insurance risk, whereby I will see higher than expected insurance claims that will be needed for such liability risk that has now been integrated to the insurance risk. So there are some challenges that we need to think about. And these particular challenges, I'll reflect on them based on the adoption of RBC framework. Now, if you are conversant with RBC or risk-based capital framework, it looks into capital requirements, and the capital requirements have to be calibrated to come up with what we call capital factors. And in this case, you'll be able to see that capital requirements are usually calibrated on a 1-year time horizon. Now, that is very specific. And in this case, then you'll see that the risks that a company will be required to hold capital on will be based on a 1-year time horizon. Now, if you look at that and compare that to sustainability risks, these risks are basically considered on the longer term as to be longer term risks. So in particular, think about climate change related risks. They're expected to emerge over a longer time horizon, which basically will present some challenges when integrating them to the current capital requirement process. Over time, then you should be able to see that the component around the time horizon changes, and that basically means that there is a lot of consideration that need to be done, particularly when you think about integrating sustainability risks within this particular framework. Now, the second component, and I'll be able to kind of connect this with my next set of slides, is that there is need to ensure that the insurance cover period is managed within the business process. So if you look at the traditional non-life insurance, the insurance cover period is usually with less than or spans to around 12 months. Now, that means that if you theoretically look at this, they might not really need to adjust pricing for the future based on their claims experience. But if you are looking at issues around sustainability, there will be need for repricing because we are looking at a more longer term value of these particular risks. And this I might give an example of maybe think about a natural catastrophe whereby claims will not be settled within only 1 year after that occurrence. So in that particular case, then sustainability at times will ensure that some of the risks that needs to be undertaken will go beyond the insurance cover period, and that will give rise to more of natural catastrophe risks that maybe require repricing over a period of time. Also, there's a component which basically we term as a tragedy of the horizon, and this is basically based on a behavior that was coined by Mark Carney. And in this case, then if you look at how investments happen, particularly market participants, they tend to believe that they can adapt the investment strategies within 10 to 20 years. And thus, they have limited incentives to consider climate change risks, in particular transition risks. And that basically means that if this is likely to happen, they might have time to quickly adapt the investment strategies within the years that they have kind of put together these particular strategies. But maybe just to reflect on these three components is that, as long as we talk about the time horizon whereby we calibrate risks of RBC within 1 year, and maybe sustainability risk will have a longer term effect, there's need to look at how those two components are aligned. And in this case, then you'll be able to see that what organizations have been trying to do, or maybe what organization will be advised to do, is to look at issues around stress testing. You would need to stress test your RBC framework and look at different scenarios of the occurrences of this sustainability risk. So for instance, look at climate change. You can look at issues around biodiversity, look at issues around um, uh, the social nature of maybe organizations changing towards a particular adherence. So all of these components might kind of reflect on how RBC would be how sustainability would impact the RBC framework. So if this needs to be integrated, there are a couple of things that we need to do as a business function. So for instance, we know RBC assures that market prices will reflect all relevant risks, and we've mentioned those risks. We have market, credit, insurance, and operational. But in order for these market prices to better reflect sustainability risks and factors, there'll be need to look at the availability and quality of information in relation to the valuation. So in terms of, are we able to critically, granularly look into the data sets and kind of provide data components that will enable us to reflect on issues affecting businesses, particularly issues that will arise out of sustainability. Then on top of that, then there's issues around scenario analysis, whereby this is a critical component that need to be applied, particularly on assessing the uncertainty. So think about climate change on the climate change impact on the valuation of assets over time, mitigation strategies to address those particular risks, but also to help ensure that the valuations continue to be appropriate, because with these new sustainability risks, they'll have a very critical impact on the valuation procedures and processes. There's also need to, at minimum, to use historical loss data, but these need to be combined with some scientific literature in terms of how then do these loss data enable us to put this data onto a more forward-looking modeling approaches to ensure that as we compute what in capital framework we term as best estimate, we ensure that it has really, we've enabled that to be proportionate to both the nature, scale, and complexity of the risks that the insurer is facing. So there will be a new way to compute best estimate in terms of how you look at both the current, how the historical data, applying science on it to look at the impact of that to the business in the near future. So in terms of how then you incorporate sustainability within the investment strategy, there are three critical components that we need to think about. So for instance, there's what we call limiting investments in non-sustainable activities or companies. So in this case, then you'll be able to see organizations trying to transition towards basically reducing their carbon footprint and trying to invest in what we call the best-in-class companies. So these are companies that would highly advocate for green strategies and are really keen into reducing their sustainability, their carbon footprint. Over and above that, then the issues around stewardship and impact investing, we will be able to see this kind of included within the investment strategies, whereby organizations will be looking at how then do they achieve social and environmental goals, and even just to ensure that they conduct some screening when they're looking into investing or putting their investments in various categories of assets. On top of that, then there's introduction of a criteria whereby the decisions will be based on an ESG rating. So this is something that we might see happening, whereby organizations will deliberately start looking at the ESG ratings and kind of also develop an internal procedure to assist them when they'll be undertaking the investment strategies. And in this case, then you'll see with that happening, it will mean that the exposure within the risk-based capital will not be as huge as before, because there's an already clear assessment process within the investment strategy. Now, when it comes to underwriting, again, we'll be able to see that repricing of risks will occur, particularly for those particular experiences, claim experiences that will be over 12 months. And what does that mean? It will mean that there will be an expounded capital requirement for those particular companies that will have their claims experience beyond 12 months. And in that case, then those that types of claims experience, the greatest impact will be sustainability risks. Then there will be also an issue of integrating ESG into the underwriting standards, whereby we'll see organizations developing guidelines and risk assessment tools for major infrastructure projects. So for instance, if there's a big construction and there's need to do an assessment of the process, and maybe they might need to see whether that assessment, that particular project passes the assessment criteria before approval, then that in one or the other will reduce the exposure that insurance risk might have within the business process. So in that case, then there's a reduction of capital requirement for insurance risks. Over and above that, we should be able to see new products coming in. And that with that, then if we see more what we call green products within the insurance business, that will indicate that the exposures and also the capital levels that might be required for this might reduce the capital for these types of products. The only challenge in this case is that data will still be an issue. So in terms of pricing, there might be an exposure on the premium reserving, particularly when it comes to underpricing, as this is something that is still developing, and data is currently being picked up. Also, we know that there will be new renewable energy infrastructure projects that might not have been, that companies have not insured before. So again, how then do you come up with a very appropriate pricing for such projects? Now, just to, because we are about to conclude, is that there's also need to look at how you kind of integrate this on OSA. And if you look at their own risk and solvency assessment, there are two critical components that this will be able to integrate sustainability risk. So for instance, if you look at physical risks, then think about the damage to collateral, maybe such as real estate investments and exposure of other real estate investments. That basically means that there's need for looking at how these risks will impact solvency. Then there's also issues around whereby you need to write down bonds and equities of companies whose property or processes are exposed to the physical effects of climate change. And that basically means that there's loss of value. And in that case, then looking at it on ORSA, then there'll be that balance of trade whereby risks increases, solvency is impacted, and also meaning that you need to critically look at the risk management infrastructure for such write-downs. In terms of the transition risks, there are three components that needs to be thought about when you are looking at your OSA process. You need to think about writing down loans and investments in companies that have large carbon footprints. And that basically means that in one or the other, these particular assets might turn to be stranded assets. And through stress testing, your OSA process, how then does that impact your own risk and solvency assessment? Also, in terms of write down of mortgage loans and investments, particularly on non-sustainable real estates. Yep. If your projects and if a company has investments that are not sustainable, then there's need to write them down and see how through the stress testing your balance of trade would be within the balance sheet, but also just increasing risk for mortgage loans and bonds and businesses that are vulnerable to energy transition. So again, you might need to apply higher capital buffers within such particular assets. So this kind of gives you an indication of what needs to happen within your current OSA process and also within the capital adequacy process. Maybe just to kind of show you an example. So over the last couple of months, I've been looking at how then you look at stress testing this component. So again, we've looked at physical risk, we look at transitional risk. We know liability risks might not arise as quickly as now because liability risks for this sustainable under sustainability will come after the impact of both physical and transition. Then the quick risks that we need to look at are these two, but also you can start maybe looking into issues around liability in the future. So for instance, if you look at physical and transitional risks, we are likely to see a bigger impact of those in the asset side. So by looking at the current value and stress testing that. So for instance, you can consider having a 25% loss on investment property and a base scenario or an adverse scenario whereby the building is completely wiped out in case of a flood. So in that case, then you assume like 100% loss of investment property. Again, also that is what might occur when it comes to landed buildings. But when it comes to transitional risks, this will be based on the external ratings and on the ESG, external ESG ratings on various types of assets. And this is something that will develop over time. And in this case, then you can apply factors on the market value of this particular investment and see how will that impact your net asset position. Now, over the long term, then you'll be able to see your capital, your change on capital adequacy based on these scenarios, and reflect on how you might need to relook into your investment portfolio and strategies regarding these particular changes. Now, if you look at issues around catastrophes, here we are going to look at return period losses over a number of years. So for instance, under the base scenario, 1 in 400 years, then under the adverse scenario, then you can think about it in 1 in 1,000 years. So this gives you an indication, and maybe in terms of some of the results that I managed to generate out of that, you'll be able to see that under base scenario, looking at how sustainability would impact organizations. So you'll get that at the start, at the base scenario, we had around 35 companies that were under very low risk, but under the adverse scenario, you see that reduces to around 5 companies, but under low, we moves from 17 to 8, under moderate, we go from 6 to 11, and high, we move from 0 to 20, but under extreme, companies that will be extremely impacted if that particular event is around 17. So again, that basically gives you an indication of number of companies. Then over different factors, particularly trying to track the ratios, you should be able to see that again, there's a big impact, and just keenly looking at that, you'll realize that the biggest impact will be on the profitability. So if you look at the combined ratio, which basically is reflective of the profitability of these particular companies, you'll see that, yeah, these sustainability risks will have a very big impact on profitability and also on loss ratios of these particular institutions. Yeah, there's a little bit of impact on liquidity, but no much effect on the top line, because again, we haven't seen new products coming in at the start, because again, we don't have adequate data. This is something that might take time before we see sustainable products coming through, and also customer preferences changing over time. Now, maybe just to get this into conclusion, what needs to be taken now for the insurance industry? We need to start thinking about ESG integration for insurance, and in this case, companies might need to think of a phased approach. So, for instance, they can have the first phase whereby you just develop your ESG strategy. You can define your strategic approach, look at various expectations, analyze the market trends, and maybe track and predict the expectations of asset owners. Then on the phase two, there's need to start implementing, whereby you can prepare an ESG roadmap, you can design your governance structure, and kind of put together key action points to support this particular implementation. Then further than that, then there's need to look at monitoring the process, whereby you can start presenting some form of reports, looking at issues around data, including the systems, with further areas of really reviewing the process and trying to start coming up with disclosure. So, for instance, coming up with the stress test portfolios, reviewing your ESG processes and key performance indicators, and even just looking at quick reports that can be presented at the board level. So this kind of gives you a very an easy step, a stepwise approach, whereby you can start by putting together a team that will look at how they manage ESG risks. You need to kind of think about integrating this into risk management, and in this case, then capital management processes come in, whereby you look at how you effectively manage ESG risks. Think about underwriting, whereby you start doing an assessment on ESG risks and providing information on how this would impact your assessment, your underwriting processes. Then think about disclosures, and at the end, then look at how your investments can start be updated within the ESG criteria. So this just gives you an idea of what really you can pursue, and basically that's what integration is all about. And maybe I'll just stop at that. I'll take it back to Sanau to see whether there are any questions. So thank you, guys, and hopefully we'll get into more detail into this. This is a topic that is still evolving. We working to see how best we could support the African continent in towards adoption of ESG. Again, this presents to us an opportunity to make our world more sustainable and basically to ensure that we address some of the societal problems. Thank you. Back to you, Sanau.
Thank you so much, Elias. I think that was a very informative talk. It was so well laid out in terms of where we're coming from, where we are now, and where we're headed in the future. So I think all of us on this call now have such a clear picture of what sort of our next steps are. And before now, I can see there are no questions on the chat or on the Q&A forum so far. So maybe I can just get us started off, maybe just a few questions. In terms of transition, I know you've laid out sort of some of the next steps in terms of the different functions that are involved. So what do you foresee as being the possible timelines to the point where we're going to start within good time, start incorporating ESG and sustainability risks towards our RBC framework? So we're not doing a scenario where in maybe 10 years, then we're playing, a racing game, we're trying to catch up to something. What do you foresee being the possible timelines, or what the timelines should be rather?
Yeah, yeah, that's a very interesting question. Now, if you look at timelines and what needs to happen, we are basically faced by sustainability risks at the moment. And the key thing is that the financial sector has to basically get into the game because it's no longer, these risks are no longer an environmental issue or a social issue or a governance issue. Now this becomes a financial issue. And with that, then it means that we need to start working. Underwriting is a key component that drives capital adequacy. Also, we need to look at how does it impact investing, because again, investing will be critical in driving capital adequacy, but also just looking at the interactions between underwriting and investments that will guide the organization, particularly the owners of business. Because at the end of the day, they want to see how much capital have I laid into the business and what profits am I really generating. So in terms of looking at the owners of capital are also looking at how then they need to address these societal issues, because if the financial sector does not support sustainability, that means that the losses will just increase. So if we don't do anything around climate change as the financial sector, then our losses will be, because we'll go higher and higher. If we don't start investing on sustainable energy and assets, then that means that our assets will be stranded. So what I would say is that this is a process that needs to start now, and mostly how it can start is basically by maybe trying to do some stress testing and kind of see how this impacts your business processes. It might take, I think the discussion is also guided by other externalities. Regulations will kind of be driving this, consumer preferences, just the general way that everyone will be thinking about the future. All these will be driving, but the key thing is that if an organization wants to start, then the discussion, it should start now, and the quick way of doing it is maybe doing a quick stress test based on some of the scenarios that I've kind of indicated.
Yeah, that's a good point, in fact, that you've mentioned. I think the important thing about webinars like this is they allow us to begin the conversation. So now, at least within our market, now we know what we need to be doing, and now we need to start laying out how we get there. So I can see in the chat that Lucy has posted a few questions. So the first question she's asked is, can the global ESG criteria currently being adopted fit into our local market in order to ensure sustainable investing?
Yeah, so the global criteria, it has far-reaching implications. And again, what I usually say is that we need to start with what will have the greatest impact. And if you look at our continent, the greatest impact will be on climate and nature. So that's the first point that we need to start with, because if we are talking about 30 out of the 40 most vulnerable countries in the world are in Africa, that means that there's need for the financial sector to work through that. If we mention that if we don't do anything by 2050, then our GDP will drop by 30% as a continent. And if we talk about GDP, that means that even the financial sector is included. So then we need to start with what will cause the greatest impact as we look at the global impacts, the global ESG criteria. So that is something that needs to be considered. Also, if you look at where various organizations are, particularly if you look at RBC, risk-based capital framework, there are three key things that framework looks into. It looks at size, looks at complexity, and looks at the risks. So again, depending on the nature of risk that an organization will be undertaking, depending on the size and also depending on the complexity of those particular risks, then we need to connect the ESG global standards to that criterion that we've always talked about. So it will not be a it will not be a one fits all approach. It will be commensurate to the level of exposure. So again, the organization should also look at how then do they incorporate those global standards within the way their sizes and the risks exposure and then the nature is looking like.
Yeah, that's true. I think it's not a one size fits all approach. We'll definitely need to tailor it towards our continent. Another question that has come up is, given our current RBC frameworks sort of inclines companies towards government bonds because they get lower capital charges if they invest in government bonds, how can we ensure that government adheres to ESG guidelines? And an example that has been given is, for example, if an infrastructure bond has been issued and is meant to raise funds towards building a structure that may not necessarily be ESG inclined, will that do you think moving forward, if the framework changes, that should impact a company's RBC capital charge, or how much is the bond as secure as a regular government bond that will be invested towards an ESG compliant,
Yeah. So if you look at the financial markets in Africa, the financial markets in Africa inherently illiquid. Maybe we can do away with likes of South Africa, but if you look at various markets, let's say Kenya, say Tanzania, say Uganda, our capital markets is inherently illiquid, and what that means is that you'll be able to get very few classes of assets that you can invest on. So it doesn't really, you don't really need to think hard on what you need to invest. For instance, in Kenya, you'll just, okay, fine, the safest investment will be government bonds. Or maybe if you try and think harder, you'll end up buying a piece of land in a place somewhere near your village. And all this, then what basically happens is that with that illiquidity, then it means that the companies in one or the other are only aligned to invest in such particular assets. But there's an evolution whereby there is an enhanced capital marketplace that we've seen over the last months. We've seen the green strategy being developed by the government here in Kenya, and I know that there are all various governments are looking into developing such strategies, and that basically opens the space for better assets that could be invested. So maybe green bonds will come in. The governments will be quite keen to support climate policies and to look at how then they respond to their NDEs, which they have signed to adhere to. So I don't foresee investments that will be highly non-sustainable. We are going to see more sustainable projects coming through. There'll be a widening base for investments, given that now there's a call for such alignments happening. But also, there will be also demand from customers, because you see, for any marketplace, there must be demand and supply. So I foresee a lot of demand, and that demand will basically mean that we are going to see a more liquid market from what we've been having in the past.
Yeah, I think you raised an interesting point where insurance companies are not operating in isolation. So obviously, as we start making changes, then our environment will start to change as well. I think the last question that has been raised is, given the challenges on the RBC time horizon, how can we spread our capital charge to accommodate this difference?
Yeah, so if you look at the capital process of determining the capital charges, they are highly aligned on a time horizon, and that's it. You look at 95 percentile or 90th percentile or 99.5 percentile, and that's how they're determined. Now that means that you are looking at a risk once in 200 years. But with sustainability risks, we might see 1 in 1,000 years, or 1 in 2,000 years, or 1 in 4,000 years. So what I foresee is that we are going to still adopt a time horizon as stipulated by RBC, but the regulators in the future will require a very stringent stress testing process that will require companies to do what we call capital add-ons, dependent on your exposure to these externalities, particularly within the sustainability risks process. And that's why if you look at one of the slides that I kind of indicate, I kind of shown how you can look at your stress test and see how these components would impact your capital adequacy. And from that, then companies through their governance processes will say, okay, fine, for each and every year, we'll have a capital add-on of X amount just to look into issues around sustainability risks. So I'm not basically totally writing off that we might not see a sustainability risk charge happening, but the key is that this should be a governance process. We might require, companies might need to do some stress tests and start applying what we call capital add-ons on the long run, just to take care of the longer term exposures that will arise out of the sustainability risks.
Okay, yes, I think that's an important point, especially because very few companies, I think if we focus on Kenya, for example, above that 200% CR mark, some are playing above 150 and some are between 100 and 150. So any additional sort of impact to the CR, the companies will feel it. So it's a good thing to start the conversation and start the awareness so that we can start preparing ourselves sort of for that impact. I can see that there are no more questions on the chat. I'd just like to inform the attendees one more question. How do you balance environmental versus social risks? So for example, with proposed oil pipelines or similar energy related infrastructure around the continent, many international insurers or reinsurers are refusing to insure these. However, you can argue that they are needed for social development and improvement of the well-being of the societies as a whole, and perhaps should be backed while the economies build capacity and transition to other renewable energy sources. Where do we draw the line? Should we be developing some sort of African rating system to reflect this and help us make the appropriate decisions?
Yeah, that's a very good question. And the key is that we believe that Africa is still yet to develop. There's still a lot of opportunities around development that basically some of the projects that might enable that will be a bit highly unsustainable. And the key would be to reflect on what will be the impact on the long run. So I'll want to give an example. There was this opportunity for the government of Kenya to basically mine coal in Lamu a few years ago. I think it might have been 2-3 years ago. And in terms of the assessment and the value of that would have meant that we would have generated more energy and maybe created more jobs. But the impact of that particular project on the coral reef, which if you look at the Kenyan coast, the issue was that nature really drives the coastal region. Then that particular project did not pick up. So in terms of the balance of trade, and that's where we'll be able to see a lot of assessments being done on the long-term impact of such particular projects. So it's not about the social good on the short term, but what will be the long-term impact across the economy. So that is something that is likely to happen. There was also an example whereby there was a road that was supposed to be done, I think, in part of central Kenya that was stalled because it was passing through a forest. Yeah, and the Kenya National Highways had to rethink of that particular project, though the residents really needed that road, but again, it had a longer impact on nature, whereby they would have destroyed a big forest that supports the biodiversity within that particular area. So again, there are things that we need to think about. So the balance is on short-term good versus long-term impact, and that is something that we might see happening as we move. Also, Africa is highly blessed with renewable sources of energy, and this is something that we might need to start reflecting on, because it will mean that it might require a bit of investment, but as there's evolution on technology and all that, these are some of the things that we might quickly start getting value. So maybe I'll give you an example. We've been working on geothermal energy, both here in Kenya and Ethiopia, and we are basically exploring geo energy and supporting institutions, even in terms of how do they underwrite such renewable sources of energy, and maybe in the long term, I will be able to see more organizations looking into how they can start basically ensuring some of these renewable sources of energy.
Yeah, okay. I think the last question, maybe before we conclude, comes from James, and is asking, to monitor the ESG, companies need to establish a strong employee culture, clear policies and software systems. Do you think we can make this work in the near future?
Yeah, so yeah, definitely. That will be enabled, but also, it needs us to start policies and procedures. There's somebody that has to put his head out and start basically pointing out some of these particular procedures and developing these technologies. So I think that is something that will happen. The only thing that we need to do is to have more conversations, start putting together data that will enable these tools to be created and these procedures to be adopted.
Okay, yes, I agree. I think we've been going for a bit over an hour and a half now, so it's a good time to conclude the discussion now. I would encourage anyone else who has any questions or comments or wants to reach out to the panel to engage with our social media. Our LinkedIn is quite active, and you manage to get a response maybe within a day or two. And we're always open to, again, as I've said many times, continuing the discussion and making sure that this is something that we're very engaged with as we continue to work towards a more sustainable future. So once again, I'd like to thank you so much, Elias, for joining us and for that great talk. And if there are no further comments, then we can conclude the webinar here. Thank you so much, everyone, for joining us. We hope that you've learned a lot. And again, I'll mention, please engage with our social media and our LinkedIn, especially, so that we can continue the conversation and get more engagement on the subject. Enjoy the rest of your evening, everyone. Thank you.